So on the net interest income question, that's always been a question mark this whole cycle. And now that the outlook for interest rates has changed so much, how does that impact profitability going forward for you?
Well, it's $14 billion plus a quarter, and it peaked at $14.8 billion and then went down to $13.9 last quarter, and now it's coming back off of that. And so it's a major way we generate value. We take deposits, make loans, and then we have wealth management fees, and we have trading revenue and all kinds of stuff. But it's a big part of our revenue base. We have $25 billion of revenue a quarter, and 14 of it's NII. And by the way, it flows through the profitability faster because if you make more margin off the same deposits, it obviously benefits you. You're not doing any more work in that, so you get the earnings stability of the company.
What are your expectations as far as rate cuts from here?
So our team, Candace Browning Platt and the research team, which are the best in the business, they now have 3 cuts in the fourth quarter, beginning in the September meeting in each meeting. Yep. And then they ultimately end up at a terminal rate or a terminal short-term rate or the end point, 3.25 to 3.5. And so there's a big debate of whether it's 3 or 4 or 2 or 4, and that's all interesting. The real question is somewhere over the next 6-8 quarters, you'll get to the end point, and our team believes that is 3.25, 3.5, which would mean a fundamentally higher interest rate environment than anybody has been in the business really since 2006 and 7. So think of how long that is, where the business has really not had that much of a real rate environment, a real nominal rate environment. And so that's the real thing to pay attention to, not necessarily which happens which quarter, but where we're going to end up and then how that affects the economy and borrowing and business after that.
So you think we should get used to higher rates ultimately wherever this ends up? And what are the implications of that? Do you think the market's mispricing that?
Well, if the economy is growing and withstand those rates, that's actually a good thing because that's a more normal environment. We can't have a low rate structure. It means that the economy isn't performing. You're not getting enough inflation. I was talking to a former central banker, and he said, why are they trying to cut off inflation? It took us 15 years to try to get inflation back, and we finally get it back. So there's a debate. So as you move down towards the level of 2%, the target, you have to slow down and make sure you stay above it because you can't average 2% unless you're above it sometimes because you're going to go below it. So a higher nominal rate with the right inflation tamed is actually a better place for a big economy like the U.S. to be than a very low rate structure. We learned that lesson in 40 years in Japan.
Jamie Dimon today warned that he's worried about stagflation. It sounds like you don't agree with that.
No, our research team sort of says no stagflation issue right now. That was because they believe that the underlying economy grows at 2% as we move into the end of this year. It bottoms out at 1.5 and kind of comes back to 2. That is all sort of trend growth rates. And they see that with the unemployment, 4.2, maybe moves up to 4.4, 4.5, and then kind of trends back down. And what we see as a consumer activity is consistent with a low growth, low inflation economy and has stabilized. And that was important because it came from a very fast growth rate in 23 first part versus 22, slowed down as we came through 23 as we sort of normalized after COVID. And then, but the worry was it would keep slowing down, and now it's stabilized about a 4%.
Consumers not getting worse right now?
Consumers not getting worse right now. They're very stable.
Because Ally Financial this morning at this conference warned that auto and card delinquencies were worse than expected.
We're seeing them come out where we thought they'd come out, and delinquencies have gone back to where they were more or less in 19. Charge-offs have stabilized after that. And again, people forget that 19 was a very good credit year for our industry. It was like a 50-year credit low for charge-offs in our company. To give you a sense, that's how good it was. So we're only back to around that. And in the consumer side, and consumers have the money in their accounts. They're spending wisely. They're employed. They're getting paid more. Inflation's tough on certain income strata. Unemployment has kicked up a little bit. The job market's softer. This is why the Fed has to start to get more accommodative and not the real drag on the economy. The real rate structure is 200 basis points plus, and they've got to start to normalize it.